Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Welcome to Stockwatch. I'm Zinati Guma, and join me to unpack your stock-related questions today are Ricus Reeders from PSG Hole in One Ruimsig and Gary Booysen from Rand Swiss. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Lots of interesting company news that came out today and lots of interesting questions that we have received from the viewers as well. But surprisingly, no one has asked about Sasol. I'm guessing everyone is happy at this point. Gary, that rocketed about 17% and it just kept on going higher and higher and higher. Was this just the oil price or the update that they gave us for the quarter that ended in September, or a bit of both?
Yeah, I think it's definitely a bit of both. So, I think we had a 5% jump in the oil price back to $65 a barrel, and that's absolutely going to move into Sasol share price as well. So that started it, and I mean this was on obviously the announcement that new sanctions on Russia. The White House, trying to end the Ukraine war, and I think it's also to I suppose raise the issue of China's Russian oil purchases if the meeting goes ahead between Donald Trump and Xi Jinping next week. So I think it's probably a bit of a bargaining chip. But we also had a surprise decline in U.S. stockpiles as well, which also helped to lift the oil price. And then looking at the trading update, Sasol's meeting its growth targets. The performance was really within the guidance, and I think the way that Sasol is speaking to the market these days is a lot more investor friendly. There's a lot more clarity from Sasol as well. At the same time, we do expect chemical prices to remain under pressure. Obviously Sasol had its debt moved from stable to a negative outlook recently, and that was just on the view that in the next 18 months, we expect the oil price to kind of hover around $66 a barrel. We expect chemical prices to be under pressure as well, and we saw that OPEC also unwinding their production cuts. So 17% rally, that's wonderful. We hold Sasol in portfolio, so I'm very happy about that. But I think also just a little bit of caution as well. A lot of good news coming through for the stock today, but there's certainly still headwinds as well.
Yeah, you're happy now, but you weren't happy for a long time, Gary. Ricus, is Sasol shutting up the naysayers?
Well, when they came out with their first quarterly update, 6 months ago, I said, well, that was good. The market reacted very positively, but one swallow doesn't make a summer. And I was waiting for this quarterly update to see whether that trend continues. So maybe 2 swallows gives you maybe the start of spring. I certainly liked, as Gary said, the tone of the update, where they very much in their outlooks stated up front, that they are managing the things which are under their control. And certainly with that update, that seemed to be going well, whether it be the quality of their coal, whether it be what's happening in Secunda, whether it's to do with the things that they are doing to become more environmentally friendly. So they seem to be in control and giving feedback, very importantly, on how that process is going. If the oil price goes up, that will help them. If their cracker spreads improve, that will help them. But that's not what they are bargaining for in their outlook. They are managing the business. This was a very good quarterly update, and it's and it got reflected in what happened with the price today.
All right. Well, the Afrimat is also another big talking point today, and we saw, I guess, a reflection of their trading statement coming out in the results. A lot of people had been asking before these numbers if they should buy, and I hope they bought, because that stock was up 10%. As well today. Gary, just talk to me about Afrimat, because I mean, I guess the big thing we saw was kind of the improvements in the cement, on the cement side, Lafarge, but also the iron ore market as well. We did see a buoyancy there, but still are some challenges in the stock. But did investors look past those challenges in the other segments?
Yeah, clearly they looked past it. We had it was almost up as much as Sasol's. So yeah, up 14, almost 14.5% today. So investors definitely liking what they saw in the updates. I think Afrimat's been through a challenging time recently, as you say, with at least with integrating Lafarge into the business as well. It was almost expected, but I think the market has been punishing it for maybe not making enough progress, and I think we are starting to see more progress coming through there, and that's certainly helping the stock as well. It's a very different business than it was a little while ago, and of course, iron ore sales, also decent international sales coming through from the group. That's very optimistic. So things looking better, and I mean the stock is absolutely beaten down at the moment. I mean, we're trading at 45 Rand. I mean, this was an absolute market darling. Also nice to see that obviously the 20-cent dividend being declared as well. So I think pretty much good news, and you can understand why the stock was a lot higher, and hopefully this kind of heralds a more sustainable turnaround.
And it's quite interesting because they have all these different business segments, and we saw the pressure coming from the anthracite mine because of these ferrochrome smelters, and also you have the challenges with ArcelorMittal's long steel business affecting the local iron ore demand, but clearly not in this specific period. Also industrial minerals. Is it also just a case, Ricus, of the places that are feeling the pressure from these headwinds, that they're also a small part of the business and not the bigger segments of the business?
Yeah, I think so. And today's update reminds me, we were talking about Sasol. It's almost similar, to me at least.
Yeah.
Sasol 6 months ago, where they had a torrid period with really bad results. Some of it's out of their control because the product they sell is in a difficult space as well. So we've now had basically a quarterly update, and management is saying that they are addressing the problem. So it's Sasol 6 months ago, great update, market likes it. I would like to see what happens 3 months from now, how far along in that process they are. So the price is, as I said a few weeks ago, at some kind of bottom. Whether it is the bottom, I don't know, because we want to see a little bit of a track record going on. I trust management, but they are operating in a difficult product environment, and they really have to bed Lafarge down. Iron ore, as you said, looks good, but again, there is still problems with the local market, and they've got it, and anthracite's hopefully going to work out for them as well, but no guarantees on that. So it's absolutely a management process rather than relying on the prices of the product that they sell to get materially better in order to put them in a far better situation.
All right. We'll talk about operating in a difficult market. Mondi is definitely being affected by the headwinds in the macroeconomic environment. And there is a question here. Putting aside the drop in the share price, how safe or sustainable is Mondi's dividend, specifically dividend growth? Gary?
That's a good question. I'd have to have a look at that properly. So, I mean, and I think, I mean, maybe more generally, like, I mean, when I say it's a good question, it's a great question. So often investors look at the track record of dividends paid, and then suddenly you get this big share price drawdown. You're looking at the dividend yield, and you're thinking, oh, a retail investor will, scan through some dividend yields. Go, oh, look, there's a 7% dividend yield on the stock. This looks amazing. Like it must be set to continue, and that's I mean that's a very dangerous assumption to make. Companies cancel their dividends all the time. Looking at it, I mean Mondi's under pressure for a number of reasons. As you say, a lot of it is global macro issues. You look at the just I suppose packaging prices, pulp and paper grade prices as well. They're under a lot of pressure at the moment, and that specifically the weak economic backdrop in Europe is putting a lot of pressure on the stock. Like I said, I'd have to look at it properly to see like the probability that they would cut their dividend anytime soon. But I would just say, like high dividend yields historically don't mean higher dividend yields going forward. I mean, I can look at the estimates quickly for you, but I'm waiting for that to load. But
okay.
I don't know if I'd be confident that the 7.5% dividend yield would be maintained.
Okay. Yeah, I mean, very interesting and valid point that you make. Ricus, on your side?
Don't depend on dividend income from a company that's involved in a cyclical business. That's the first thing.
Yeah.
If you want to, well, again, this is my own personal preference.
Yeah.
And I've said it many times before, I like dividend growth models where there's a consistent growth in dividends from a company. It makes it more reliable, it makes it more forecastable, and it makes it more consistent. So it's lovely if you get a great dividend because a cyclical company in a cyclical business all of a sudden has a windfall because they're making huge profits because the commodity or the thing that they sell has increased in prices, but don't rely on it.
Okay. There's a question from a pensioner. Which stock or stocks on the JSE have a growth rate of equal more than inflation and pay a decent dividend? So one stock, maybe more than one if you feel like it. Ricus?
Yeah, I mean, just what growth rate? Earnings growth rate? I would imagine that's what we're talking about. And then you've just got to go and take a look at your sort of blue chips or banks for that matter. Banks, I'll say, they have reasonably consistent growth rate and reasonably consistent high dividend yields. Sometimes they are cheap, as they are right now, or cheapish, shall I rather say. And they've got a tendency to maintain their dividends. So that's one sector I will take a look at. Otherwise, things like Bidvest, which is sitting, I think, a decent value at a decent dividend yield, and they've proven to be consistent earnings growth, sometimes not as good as other times, but they've got the track record to give you that measure of confidence.
All right. Ricus is on to banks and Bidvest. Where would you be looking, Gary?
Yeah, I think Ricus makes a good point there as well. So, again, firstly, like when you say, a share price that is growing faster, what is growing faster? I can give you a list of, I've got them up here. It's probably 30, 40 companies in the all-share index that are growing their revenue. Their compound annual revenue growth over the last 5 years is more than inflation. Now, inflation is also exceptionally low today at kind of between 3 and 4%, and is it going to stay there as well? So I mean, do you want to try and link to a company that their earnings or their revenue growth is going to have a high probability of matching what the inflation rate is going to be? I think that's one thing to consider as well. And I think you've got to look at the security of the dividend as well. And the banks are, I suppose, the natural place that if you are a pensioner that is going to go into an equity style portfolio with the hope of getting dividends, bank dividends generally are very, very safe. Our banks are to an extent constrained in terms of their growth rate to the economic growth rate as well. but I mean, they should also match inflation. So I agree with Ricus there. Again, it's very dangerous just to look at let's say a 5-year growth rate in earnings or revenue, and say, okay, well, and there's a high dividend yield on that. That's where you kind of want your portfolio, because I can tell you what's topping the chart at the moment are the likes of Harmony, some of the things like Tungela. You've got Implats up there as well. So these are obviously companies that have benefited from a huge rise in precious metal prices, huge rises in kind of like their base commodities. And as Ricus was saying in the question previously, these are very cyclical industries. They're paying high dividends now, and it makes it look good today. But as a pensioner, do you really want to be putting your money into very cyclical industries where the share price is going to be, it's a high beta play, like it's going to be incredibly volatile. So, as a pensioner, again, it's difficult to kind of answer some of these questions on the show, because you kind of just want to speak to this person directly and say, okay, cool, let's look at the overall portfolio. Do you really need to be in stocks trying to get, a dividend return here? There's plenty of fixed income products that will probably solve your problem without having to take equity-like risks. So, and there's always, I suppose, again, it's a common misconception. I'm going to buy a dividend-paying stock because then I don't have to touch my capital, and that cash flow is going to come out for me. I'm going to live off the cash flow. These days, shares, these companies return money to shareholders, in two ways: dividends and often via share buybacks as well. Both are healthy companies that are returning capital to you. And if you're, kind of planning for retirement, and you're planning to live off your investment portfolio, the fact that you're taking a cash flow through dividend, or if you're selling down a couple of shares because the cash is being returned through a share buyback, it's often more in your interest to take the capital appreciation, because your tax rate is going to be lower as well. So there's a lot that goes into that question. I'd be very nervous to say to someone, go out and buy these banks because you'll be absolutely fine in your retirement because the dividends are secure. It's almost like, I think you first need to address the fundamental premise of how you're approaching your cash flow in retirement, and that's going to be a lot more important.
All right. Well, thank you for that, Gary. There's a very interesting one here. I have Naspers and Prosus shares in my portfolio. Should I sell my Prosus for Sygnia shares? Sygnia is on my watch list and is looking attractive. I don't know. Does it need to be an either or here, Ricus? Because I would imagine that it would be good to have both in a portfolio.
Yeah, I mean, just taking a look over the past year, both of the options are up. I mean, Prosus has outperformed Sygnia by about 15 or 20%, but Sygnia hasn't done badly. So in that sense, you're obviously getting a bit more diversification, I would imagine, via Sygnia, just because of the product they sell, but also the nature of the product, which basically funds in various geographies and sectors of the market. So I wouldn't make it sell the one and buy the other. That being said, Naspers Prosus, I mean, Prosus is doing a lot of stuff that is divorcing them from being solely reliant on Tencent for their growth. But there still is Tencent, there still is China, and China still is a huge problem for me. I think it's eminently tradable, Chinese stocks or Chinese associated stocks like Tencent or Prosus, but you have to be very cognizant of the fact that Xi Jinping and the Chinese government at any stage can put in legislation or a rule that has a very negative effect on whatever Chinese company or whatever Chinese sector you are in. Be aware of that.
Okay. All right. Interesting. I mean, but also I was looking at that Prosus chart, and you're right, Ricus, it has outperformed. And I'm thinking, maybe if you really want to get some profits from Prosus, maybe just take some off the table, but not everything off the table, and then go buy your Sygnia. How would you be approaching this, Gary?
Yeah, I think also, I mean, an interesting switch, very different prospects. And you'd almost, again, I don't want to cop out, but it's, you almost need to put this in the context of the overall investment portfolio. I don't think either is particularly bad. I don't know why, there's no, I suppose, urgent need for me to take profits on Prosus at the moment. We hold it in portfolios. We like it. It's not particularly expensive. I think Ricus has pointed out the risks around investing in China. But if you are if you're a JSE investor, I mean, this is still, I think, one of the most exciting stocks to hold in a portfolio. We've seen the massive recovery that we've seen in Chinese equities this year. Prosus has been, the Prosus Naspers pair has been one of the best performing positions in the market, short of the gold and platinum miners. I mean, it's right up there as the Chinese economy recovers. I think often, I mean, you understand, and I totally understand, Ricus's view on China and the concerns that you have around the government in China and the ability for, at a stroke of a pen to destroy an entire industry. I mean, we all kind of remember what they did to their private education sector a little while ago, what they did to their gaming stock sector. But, you do get the sense that many investors, and again, it depends on who you're talking about, but are potentially underinvested in China. It's important to realize that for hundreds of years, China was the leading economy globally, and we've almost gone through an unusual period over the last, let's say 5-6 decades where China hasn't been on top. If we and you can kind of see, if you look at the geopolitical situation at the moment, America is incredibly concerned about the rising power of China, and China is an exciting economy. There's no question of it. There's demographic issues. I mean, their working age population has peaked. That is a concern, but this is a powerhouse that often you find investors are, I suppose, are shying away from because of the how opaque the regulatory environment is, and they're underinvested. And the fact is that if you look at some of the valuations on U.S. companies, and we understand why U.S. companies are so attractive. We understand that the environment in the U.S. is just so investor friendly, or used to be. I don't know if it is as much anymore, but it is a very investor friendly environment. But the Chinese securities, they trade at deep discounts as well, and a lot of that risk that Ricus is talking about is priced into the securities as well. So I definitely wouldn't throw out my Prosus at this point. I think China has got a very exciting couple of years ahead of it. I mean, obviously this is all going to depend on how the trade war plays out. But this, I mean, if you look at this, and I'm just going to talk in beta terms to all share index. So if you look at like a risk measure on Prosus currently, I mean, you're looking at about 0.85. Sygnia, a very different prospect. Kind of almost like outside of the index, their 5-year beta is sitting at 0.339. So, a lot less volatile technically than something like Prosus. It's a financial services company. It's a completely different investment thesis that you're going into in something like Sygnia. As Ricus says, when equity markets are rising, and equity markets have been rising, their funds, naturally, you have more assets under management. Sygnia also put through pricing increases. For a long time, they were attracting capital by being kind of more digital, really hammering, we're lower cost than anyone else. They've done adjustments now that their platform fees have gone up. Their fund fees have gone up. It's and they're almost cashing in on this huge asset base that they've managed to grow. They've also seen growth because of market growth as well. So I think Sygnia is sitting in a good position, and you can understand why the share price has reacted as positively as it has. I mean, 41% up year to date. I think again, we're kind of in the industry, so it's like. I would maybe be a little bit careful because I don't know if Sygnia has the pricing power that potentially they think they have. And when you for many years followed a low cost model and then suddenly increase your prices, it takes a while for assets to move because assets do tend to be sticky, but they will move. And I think that could hamper Sygnia on let's say a 5-year view. So after the run up that we've seen now, I would maybe be a little bit more cautious of Sygnia.
All right. Well, gents, let us get to your stock picks. Have about 30 seconds each. Ricus, what are you choosing?
Well, first of all, it's because the graph looks terrific, and it's Grindrod. But apart from that, I was looking through Afrimat and Ruimsig's results today, and their commentary generally on, Afrimat's their iron ore and specifically to do with logistics. And I think Grindrod, specifically with their new CEO, Booysen, that's been appointed from Transnet, takeover of the Maputo terminal, basically buying out minorities there, their concentration on high-end technical services at a decent cost. There's a lot that they have to manage at the moment, but I think the environment that they are in, whether it be the rail support, Richards Bay coal terminal, all of these things are starting to look very good from a macro perspective, and then for the company itself.
Okay.
It's not cheap, the company, I mean, but if things go right on the ground, they should benefit. And I think the price is telling us something, having gone to a 52-week high. So, it's not a granny stock, but I think it's a very interesting trading stock at the moment.
All right. Gary, 20 seconds, your stock pick.
I'm going to go with Advotech. We like the private education space. I think, the private education trends in South Africa are very strong. Their African expansion, from what we can tell, is going very, very well as well. It's a play into the demographic dividend in Africa if you're looking longer term. You look at their 5-year earnings growth. It's around just under 11%, but that also takes into account the COVID period, which obviously we did see a little bit of a dip in their earnings. You take it after the COVID period, and it just shows how much, taking a specific point in time changes things. That escalates materially. It's not particularly expensive compared to something like Stadio. We like Stadio as well, don't get me wrong, but at 30 times earnings on Stadio and 15, call it just sub 16 times earnings on Advotech, I think there's a valuation play here, and I think you could see that gap narrow. Year-to-date return on Stadio, you're looking at 60%, Advotech only 3.5%. Okay. And now Advotech doesn't quite have the growth story that Stadio has going for it, but it's also certainly not resting on its laurels as it expands into Africa. So they have a strong growth track record. I would play that pair. I would say buy Advotech at this stage. You should be okay. Okay.
Well, thank you so much for your time and for your analysis, gents. Always appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Ricus Reeders from PSG Hole in Ruimsig and Gary Booysen from Rand Swiss. Up next, The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.